Today we're going to talk about this week's FOMC meeting. As expected, the Federal Open Market Committee left the benchmark rate unchanged. The Fed did, however, announce formal plans to reduce its $4.5 trillion balance sheet. So starting in October, the Fed will allow $6 billion in treasuries and $4 billion in mortgages to run off each month. Every quarter, they're going to increase the runoff until $30 billion of treasuries and $20 billion of mortgages run off each month. The Fed did not give a time frame for when the runoff would stop and at what level of balance sheet they will maintain. Conservatively speaking, it would take 8 years at that pace to reduce the balance sheet to zero. Now, this balance sheet move was widely expected by the market. What surprised the market a tad was that a majority of the FOMC members, in addition to the balance sheet wind down, also want to increase the Fed funds rate one more time this year, likely in December. So in summary, the Fed will start unwinding the balance sheet, which in effect is like slowly raising interest rates, as well as potentially raising rates in December, along with the general consensus that they plan to raise rates 3 more times next year. And what was the market's reaction to all of this news? Rates went up only 2 basis points. You might be asking yourself why there was such a small reaction by the market. The first thing you have to remember is that we still do not have tax reform, healthcare reform, an infrastructure spending bill, or inflation for that matter. Also keep in mind that while rates are low in the United States, they are generally much lower in other countries around the world. So Treasury and mortgage yields are very attractive to investors. Not to mention the impacts of Hurricanes Harvey and Irma have not filtered through the economic data. In the coming weeks, you should keep an eye on the following items: the spread between mortgage and treasury rates and the impact of the winding of the Fed's balance sheet. You might see mortgages move with more volatility than treasuries, but I'll get more into that next time. Next week brings GDP data from the second quarter as well as core PCE. And lastly, any further comments from the Fed in terms of policy for the remainder of the year. If you'd like a more in-depth analysis, please visit our blog. Thanks for watching and have a great day.